takes us right to our talk of the tape. What stocks are likely to do in the weeks ahead and how the next 5 days will be critical to that outcome. Let's ask Wharton Professor of Finance, Jeremy Siegel. You see him there as he joins us now. Professor, welcome back.
Happy to be here, Scott.
I'm so happy to have you with us today because we do have so much important lying ahead. The state of the market today to you is what?
I'm still positive on the market. We are selling for 20 times earnings, although, I mean, if you're a growth stock, you're selling at 25 to 30. If you're a value stock, you're selling at 15, 14. So there is a difference. Overall, 20 is okay. It's not cheap. And I still think we can get 8 to 10% for the year. The economy is still very strong. I think we're actually going to beat 242 earnings on the S&P 500. As a result, I think stocks could advance.
I mean, earnings haven't been really good, though, to start things off. Are you kind of disappointed with the way we've started? Because, I mean, let's be honest, they just have not been good.
Well, I mean, there's been a few headline ones like Intel, particularly Tesla. I mean, that does
3M, Tesla, I mean, Intel. I mean, I could go on.
Okay, I thought I had read earlier that 70% had beat, which is, I think, a little bit lower than the historical average, which is about 75, 78%. I mean, we have to see how everything falls out of this. But, you know, notwithstanding, I think all the news about a soft landing and no recession keeps on getting stronger and stronger with every day of data that we get.
So you said, I think a moment ago, you could get 8 to 10% this year. I thought the last time we spoke, you were thinking maybe 10 to 15. Have you muted those expectations because what we did towards the end of the year and now where the overall multiple has gone to?
Well, I'm talking about from today. We have gone up a few percent, so that does bring us down a little bit. And the fact that, you know, when you take a look at the multiple, I don't think the Fed is, I mean, we're going to hear next week. I think they're going to be really reluctant to say they're going to be lowering rates soon because the economy is so strong, they can afford to stay higher for longer. That might disappoint the street somewhat, although I've maintained that I much rather have a stronger economy with better earnings than the Fed rapidly lowering rates because they see a recession. So I don't think a bull market really depends on them lowering rates quickly, but nonetheless, I think that I think the rates are going to be staying higher for longer. Maybe that will dampen stocks a bit, but I still think, I mean, look at even 8 to 10%. That's still a very, very good return. Yeah. Much better than you're going to get on bonds.
Do you think that the broadening out of the market happens more substantially, and that's how you get the 8 to 10, 12, whatever percent? Or is it still going to be a go big and go home market?
It's so hard to say. I mean, you know, Tesla, is the first of the Mag 7 to fall, if you want to call it that. I think you need more earnings disappointments on those growth stocks to change the momentum, but let's not put that out of, consideration. I think there's a story about how fast things can change. I mean, we were just hearing about Florida passing laws against social media. I mean, what happens? I mean, there's a lot of anti-tech attitudes. What happens if the U.S. Congress decides to move in some way against tech? I mean, what happens to Meta? What happens to all these companies that depend on that? I mean, there's always threats out there. It isn't always, smooth sailing. And as long as there's those threats out there, I would move to those lower PE stocks. They don't need the growth in order to get the great returns that I think are inherent in their company.